What's up, guys? It's Blue here, and I'd like to welcome you to the new episode of Blockchain Central. In today's episode, we'll discuss all matters concerning taxes of virtual goods. While we'll do our best to be as accurate and as helpful as possible, please note that the content of this episode does neither represent financial, legal, or tax advice, nor is it supposed to be understood or interpreted as solicitation to buy or sell any securities, coins, or tokens. Since most of you guys are busy trading your Bitcoins, Ethers, and altcoins, I'm guessing you've had a brilliant 2017 in terms of performance. Most digital assets have achieved pretty nice gains while chasing from one all-time high to the next. In fact, even institutional investors are now looking at ways to invest in cryptocurrencies and ICOs as brand new asset class. But with all of these speculations running around, we need to pause for a second to remember one of our most important and probably also most dreaded duties, the income tax declaration. Before you shrug this off, let me be clear on the first huge misconception about the tax treatment of digital assets you may have. They are, by no means, tax-free. Let's try to clear things up. Based on the ruling by the European Supreme Court, transactions in Bitcoins are not subject to VAT. So, in this respect, there is an EU-wide consensus on tax treatment of cryptocurrencies. However, please bear in mind that this regulation is not based on the legal classification of digital assets, but results from the interpretation of the EU's VAT directive. Therefore, you need to be aware that until today, there is no definite legal certainty of the income tax treatment of blockchain-based assets. How does this work in practice? Let's look at some of the most prominent financial markets in Europe. For example, according to the statements made by the German Ministry of Finance, Bitcoins are to be classified as private money or legal tender. So the general opinion among experts is that, by extension, all cryptocurrencies and tokens should be treated the same. What this would also mean is that, from a tax perspective, all digital assets should be considered equal to precious metals, art, or real estate. So, what this basically implies is that, at least for the German market, unlike financial instruments, digital assets would not fall under the flat rate withholding tax. Therefore, any capital gains you have made are taxed at your individual progressive rate. Unfortunately, the things turn out to be more subtle than the Germans would prefer it. Looking again at the example of Germany, the Income Tax Act defines a so-called speculation period of 1 year in Section 23. It implies that if you buy or hold your coins for at least that amount of time, the entire capital gain you realize on these coins becomes tax-free. Before you pop the champagne though, a word of caution. In order for that to happen, you have to be able to determine the amount of gain, prove the length of holding period, and proactively report the income on your tax declaration. The point, however, is that all your gains you have made from trading cryptos and tokens need to be well documented. Otherwise, you may run into the risk of getting in trouble with tax authorities. For that reason, you should have a good overview of your trading activities and, if necessary, talk to your tax consultant. Let me also remind you that the legal framework of tax treatment of digital assets still has to be put in place. As you're probably well aware, the different types of blockchain-based tokens are all structured in different ways, especially since the business model behind the companies issue these tokens can differ drastically. What's more, they essentially only use the blockchain as a tool for handling transactions. As a result, it can be argued that the existing tax rule for these business models should also be applied to the tokens based on the respective use cases and classifications. As you can clearly see, a framework for categorizing digital assets is urgently needed to shed some light on the issue of tax treatment. Now, to highlight the fact that this is a hot topic for discussion, the Frankfurt School of Economics, in cooperation with the firm Cryptotax, published an estimation of the additional amount of taxes collectible in Germany for 2017. They assume that the market cap has increased by 460 billion euro in 2017, a share of 3.5% of users in Germany, and that only 15% of the capital gains is taxable. Based on this, they arrived at an estimated tax basis of 2.42 billion euro. So if we say individual tax rate averages 30% in Germany, the additional income tax collected in 2017 from investments in digital assets amounts to roughly 726 million euro. As you can see, that is a lot of money. And understandably, the authorities have every reason to quickly pass tax legislation in order to get their hands on it. So, what you can take away from this video is that no proper legal framework for the tax treatment of your tokens and cryptos is currently in place. The regulation can vary a lot from country to country. Nevertheless, you must always be able to provide a nice and clean overview of your trading activities and holdings. As a general rule, you should always stay informed, and in any case of doubt, check back with your tax consultant. Thanks for watching. I hope you found this overview useful. Please be sure to check out our other videos, and if you like this video, make sure you hit the like button, share it with others, and don't forget to subscribe to Blockchain Central and never miss a beat. Happy investing.